Let's welcome in Tom Lee, Fundstrat's managing partner, head of research, also a CNBC contributor. It's good to see you on this Friday. Welcome back, Tom.
Thank you, Scott. Great to see you.
I led in here with the fact that, we have this streak going for stocks. We above 5,800 for the S&P for the first time ever, though it seems to me from your notes that you're a little bit cautious as this month progresses. Why?
Well, Scott, we're cautious, but we advised our clients to be buying the dips. And the reason we're cautious is that I'm probably saying something very obvious, but I think investors want to see who ends up becoming president after Election Day. So I think we are in a period where markets are just sitting on the sidelines, but at the same time, 2024 has been such a strong year, Scott, that I think the last 2 weeks have proven that maybe macro is taking a little bit of a step back now, and liquidity and all this cash on the sidelines is really the dominant factor.
You think we just have to get the election out of the way, and then it sort of clears the way for what you still think can be a pretty decent rally? I think your target's 6,000 or around that.
Yeah, Scott, there's a lot of firepower supporting stocks post-election because we've got a Fed that's dovish and the economy looks healthy. I don't think we're in a recession. And so, the 3-month and 6-month outlooks are very strong for stocks. And I think China, while there's maybe some hesitation, but China's government is really starting to unleash some measures, and that's supportive of that region finally turning. And of course, the third factor is, I think after 2 years, investors who've been very cautious are starting to realize that, the $6 trillion of cash on the sidelines and the low levels of margin debt need to be put to work at a time when the Fed is supporting the economy.
The other possible headwinds, I think, are ones that are maybe outside of the political cycle, at least as people, refer to them. Valuations, they say, are too rich or stretched, right? The S&P is about 21.5. That's above, obviously, its historical average. Yields are up. Now, you could make the argument that they're up for the right reason, but I think they're still up a little bit more than people thought they might be after the Fed did its 50. And then if the Fed's going to be a little bit slower and smaller in the way they progress with rate cuts, is that an issue? Of course, the flip side of that is, well, why would they need to do anything anymore anyway? Because the economy is as resilient as you just suggested it is.
Yeah. Well, on all those points, Scott, on valuation, I know people use the aggregate number for the S&P, but it is misleading because, as we know, the top 7 stocks do have a higher deserve multiple, and the median PE, it's not that much cheaper, but it's around 18 times. But that's not a bad deal considering the 10-year yield is actually a 25 PE. And with regard to the Fed cuts possibly slowing, I think what really matters now is the Fed is on a path to essentially normalize interest rates back towards neutral because the inflation pressures are ebbing. I mean, I think even CPI this week, even though it was a little hotter than expected, really didn't send the signal that inflation's reaccelerating. And so the Fed is, on a path towards 3%. And I think that's really constructive for stocks.